Welcome to HDFC Life presents live sessions in partnership with ET Now. Now, retirement may feel like a far-off milestone, but in today's India, with rising life expectancy, inflation and changing family dynamics, financial independence in one's golden years has never been more critical. Planning ahead is no longer optional, it's essential. In this episode today, we explore how banks and insurers are working together to help Indians prepare for life after work. Whether that means starting early, making smart choices, or leveraging life insurance solutions for long-term financial security. Joining me today are two leaders who bring deep insights into this very conversation. Mr. Venkatraman R, EVP and National Business Manager, Bancassurance, Investment Products and Virtual Relationship Banking, Equitas Small Finance Bank. And also Mr. Namit Rai, Group Head, Key Alliances, HDFC Life. Venkat, Namit, both of you, thank you so much for your time today. But Venkat, if I could start off with you, when you talk about life expectancy, we're all living longer. That also means longer retirement periods, right? And longer need for insurance as well. How is it that you're mapping the entire financial journey? Because your need from insurance is much more specific and elongated to begin with.
Okay, so put this in a perspective, we're talking about retirement as a approach towards using various products. See, one of the fundamental issue today is the life expectancy has gone up, right? Today, the latest record says that average life expectancy is around 72 years, which means you're going to live longer for another, 15, 20 years for you to actually have money to spend
post your retirement.
Post the retirement, continue to have the same lifestyle that you probably enjoyed when you were working. Now, there are two scenarios that arises. One is your employability goes off after 60 years, and then your medical, actually that is where the biggest challenge today is. Yeah. Today, your medical inflation is at as high as 15%, which means you need to provision a good amount of corpus for your medical expenses and also plan for the lifestyle. Today, the biggest challenge is that the family demographics have changed, and people in urban cities, if you see, they are moving more and more away from the joint family scenario to, nuclear family kind of structure. When you were in a joint family, the fallback mechanism was very much there. When you needed a financial support, there was a fallback mechanism. But more and more in a nuclear family structure, you need to actually take care of yourself and plan for the requirements. Age group between 35 to 50, which is a sandwich generation, you may call it today, they have a big challenge because they have to take care of their children's education and requirements, and also they have a dependent parents whose health needs, etc., has to be taken care, besides their own lifestyle expenses and other things. So it's a very big challenge in terms of planning for the retirement at this point of time. Now, interestingly, if you look at the age, the average age of an Indian today is around 28 to 30, which actually gives a lot of scope for people to plan early so that they are prepared, post-retirement in terms of whatever they require. But unfortunately, today we are also moving into a consumerism where spend is more than the savings. People are more pushed towards the spend, and this is
the aspiration is even higher.
Aspiration is very high. Yeah. So people tend to miss out on that basic requirement as far as savings is concerned. Now, for a moment, let's keep life insurance as a product. But then if you look at overall, savings as a component is needed for you to be prepared for the future. Now, when you look at savings, I just believe in a thumb rule, it is 25 to 30% of your income should go into savings. Now, that 25 to 30% today, whether it is sufficient, I don't know, depends upon what your lifestyle is, depends upon what your need is. So I normally, when I talk to people, I say income minus expenditure is equal to saving is what people say. I say reverse the formula, whatever earning minus the saving is what you need to spend, which is what probably our parents would have taught us also, spend less and save more. Products which are in the scope of life insurance, you have multiple products. Life insurance predominantly is a long-term saving. Now, we look at short-term saving, medium-term saving and a long-term saving. When it comes to short and medium, today there are a lot of traditional products which banks offer. But life insurance is a very disciplined product for retirement planning, I would say, because one, it's a long-term, and then you are giving a compulsory, on a yearly basis or a monthly basis or whatever, you're keeping a portion for which you use that as saving. Besides life insurance, you have other products also I think what is needed today is having a different asset class within your portfolio, and then make sure that you are planning for your retirement very well and start early in advance, so that you have a good amount of corpus that will take care of your lifestyle needs and medical emergencies as you post retirement.
Namit, exactly from what Venkat is saying, there is the sandwich generation which has to look after older parents, growing up kids, and plan for their retirement. And then there is the YOLO feeling as well since COVID. You only live once, let's spend, let's aspire to live a better life. Right here, right now, you don't know what's going to happen tomorrow. Which are the various products which are relevant for today's consumers and their growing needs, plus inflation?
Yeah, as Venkat said, that this is something that in life insurance as a product, it's just not about the planning part of it, saving part of it. It's also about the planning for the retirement. Because one of the major changes that happens once you retire is that your regular income stops. And if I were to pick, there are two uncertainties that you need to account for. One is that how long do you need that support for, and who all do you need it for? Yourself, and there could be dependent on you, could be a spouse, could be anybody else. So these two things you need to take care of. In life insurance industry, there are a lot of products, innovations that have happened, and what it does is that it takes care of the uncertainty related to your future income. It guarantees you a support mechanism throughout the entirety of your remaining life. So that's something which is very, very critical, and it's only available with a pension or annuity product which is offered by the life insurance companies. Typically, immediate annuity is the most immediate product. You have a saving which you use to buy annuity, which is guaranteed for life. A new product which came up is deferred annuity. So you can lock in the rate of today for future. So if today is the rate that, if I'm a 35, 40-year-old, as Venkat was saying, I can, if this is the rate that I believe I want to lock it for when I retire, I can lock it today. I can take a policy which guarantees income based on today's interest rate. And there are various variants in that. You can take a product under joint life. You can take a product which has a life stage-based payout. And there is another product which is also inflation linked, in which you can have a fixed increase at defined intervals in the pension that comes in. And these products are really picking up very well in the life insurance space. And last data that I saw in the life insurance space, roughly 1/5 of the business is coming from retirement plannings now.
Venkat, when you look at urban India or tier 1 centers as opposed to what's happening in Bharat, 2, 3, and so on and so forth, is very different. Beyond tier 1, people are still living in that mental mindset that our children will look after us. Their current needs are more than what their future needs would be. How are they evolving as a consumer when it comes to insurance products or retirement planning?
See, obviously tier 1, they are exposed to a lot of information, and people look at various options beyond the traditional savings instrument, and they look for wealth accumulation. That's very, very nature, they do. And as I told you earlier, the family demographic details also plays a very important role when it comes to financial planning in the metro location. Now, when it comes to tier 2, tier 3 locations, they are moderately exposed to a lot of investment patterns. They still stick to the traditional investments, which is typically a bank deposit or a recurring deposit or a post office saving, which gives them a very moderate return. And these people's aspiration in terms of spend also is not that very high compared to an urban scenario. So there, the fallback mechanism, by the way the families have joined and they live there, it is also very, very high, and the fallback mechanism is also very high. But having said that, today the tier 2, tier 3 locations also, we are seeing a pattern where because of the digital and social media exposures, a lot of these youngsters who are there, they are also, getting into that spend mode. And interestingly, if you look at, they are also now slowly getting into that habit of savings, which is beyond your traditional bank deposits, a product, kind of a product. So that way, the retirement, I wouldn't say they are ready for retirement planning, but then saving as a concept, they are getting into it, and most of the people are also getting exposed, particularly the young gen who are migrating from the tier 2 to tier 3 to the metro cities. Now, they are also getting exposed, and they are looking at avenues which is beyond the traditional investment, which is, if you say in tier 2, not just deposits, they do invest in real estates also. They say in the olden, you invest only in land and gold, that takes care of everything. Tangible assets. Yeah. So they continue to believe in that aspect compared to metro cities, which look beyond those tangible assets at this point of time.
Right. Namit, when you talk about retirement planning, I think it's more about the subject also intimidates you. You don't know where to begin. What's the step-by-step guide if someone has to start planning for their retirement today? And let's assume various age brackets, 25 to 30, and then 40 and beyond, and then 50 plus. Where do they start?
I remember a quote that I read many years back, and it has stayed with me, and it's attributed to Mark Twain, says that you should plan about your future because you're going to spend the rest of your life there. It's stayed with me, and somewhere I think Venkat mentioned about it that people today look at whatever money I get, let me spend first, and whatever is left I will save from that. And you have to reverse the equation, as he rightly pointed out. You have to save because this is something which is going to determine how much money you spend on your day-to-day or lifestyle. And there's another author that I've read and I resonate with. There's a gentleman named Scott Pape who has written the book The Barefoot Investor, and he advocates for financial planning for everyone. And there is something which he speaks about, saying that expenses typically should be categorized into two parts. One is essential expenses that you need to live on a day-to-day basis, like groceries, even health insurance for that matter. And the second one is indulgences or discretionary spends that you have. So he advocates that we should have two separate accounts and you should allocate budgets to each one of them. That will help you plan for your retirement in a better manner. Now coming to how do you talk about how much money do I need at the end of my income earning phase or whenever I decide to retire. The simple equation is look at whatever is expenses that you are incurring today and multiply it by the inflation rate. It could be 4, 5, whatever is your calculation, and extrapolate that expenses. The thing about essential expenses is that there the inflation you can expect it to be slightly moderate because it is directly under the purview of government, and we being a democracy, government would not want it to go up significantly higher out of the control. But the discretionary expenses, there the inflation rate can be much higher than what you see on an average. So if you were to extrapolate the expenses that you have, we all know the rule of 72, right? For investment, that if you divide 72 by the rate of interest that you can generate, that's the time your money will double. Unfortunately, that rule applies to inflation also. So if it is 5-6% inflation, in 12 years, whatever money you're spending today will become double. So you need to take care of that aspect.
How is it that you think that there is that one actionable idea that all of us in our working lives can take, which will secure a better retirement age for us? Let me start with you, Venkat.
Very interesting question. As I told you, it's a behavioral aspect which has to be looked at as well. So one has to decide as to what is enough and what is, in terms of what they require as far as their post-retirement is concerned. And today retirement age is not something decided by us, it can be decided by what is happening in the corporate world as well. So for a salaried person, retirement age could be any age, so what needs to, as Namit was saying, now with the inflation and so many other aspects which are there, one has to bring in a discipline of saving. And for that today, if you look at, there are multiple products which are available, which can actually bring in that discipline in terms of making sure that you save first and then start spending. Discretionary spending, as what Namit was referring to, one has to decide what is needed and what is beyond need that they are going to splurge on. So that way, if you can control on expenses, then automatically your saving corpus is going to increase. Then you decide on what instrument you are going to be, which asset class you are going to invest, which can give you a better return as you move. Beyond the traditional products that are there, long-term products which we say, life insurance products or many other, your public provident fund and EPF kind of products are also giving a good returns in terms of for the long term. Prepare for the medical emergencies. That's one single most reason I would emphasize on, because nobody looks at medical in terms of the insurance that is needed today. And if the cost of premium is going to be high, it will be even more higher as you age. And beyond every age, the premium goes up. And with the medical inflation also growing, the premium cost will continue to grow, which means one has to plan for a corpus which they will keep ready for any eventualities. Even if they don't have a premium of good sum assured size, they should be able to. So from that perspective, I think planning early, and one should start early in terms of saving rather than deferring, because every 1 year that you defer you lose that power of compounding what you would have saved. So that way, I think it's important, save now and save it for the rainy days, what I would say.
Namit, lastly, how do you think banks can be a catalyst for us to help plan our retirement better?
So the good thing about India is that banks have a lot of credibility when it comes to consumers, and you have the best of professionals working, and they are governed by a regulator which is always taken steps to protect the interest of the customers. So when you look at a bank, it helps us reach to the nook and corner. You spoke about tier 2, 3, I'll say tier 4, tier 5 also, everywhere. Bank is one of the biggest distribution channels that we have, which helps us reach the last household, last mile helps us cover. So what banks do for us as an insurance industry, or even for a mutual fund or an NPS, they make all the products available to the last customer, what entire bouquet of products. And it's no surprise that today banks are at the forefront of the distribution that we have in India, and all the financial products are there. I would add one thing to what Venkat said, is that when you plan for your retirement, when you plan for your post income earning days, you must distinguish between what you need to take care of your essential expenses, and then the discretionary gets built on that part. If not anything else, you should at least plan for your essential expenses with a fixed monthly or half yearly or quarterly annuity from an insurance company. They are the best professional fund managers which can give you a sustained life throughout your lifetime. So that's my advice.
Lot of food for thought. Thank you, Namit, Venkat, both of you. Good speaking with you.
Pleasure.
Thanks so much.
Thank you so much
for sharing such valuable perspectives today. What we've heard is clear. Retirement is not a distant event, but a stage of life that requires thoughtful planning, starting early, saving consistently, and protecting against uncertainties. Life insurance plays a pivotal role here by combining protection with retirement, focused solutions that ensure dignity, security, and financial independence in the golden years. As India looks ahead, the journey toward retirement security must be built on collaboration between banks, insurers, and policymakers. Together, they can expand financial literacy, provide innovative and easy-to-access retirement solutions, and address challenges like rising healthcare costs and longer life expectancy. By doing so, India can move steadily toward a future where every individual has the tools and confidence to retire with dignity and independence. That's all on this episode of HDFC Life Presents Life Sessions in partnership with ET Now. Stay with us for more conversations on how financial protection is shaping a stronger, more secure India.